Okay, folks. Hi, Sam Horowitz with Colliers, New Jersey office here. I think we're going to go ahead and get started. Thanks for joining us today. Pleased that we can get the Colliers, New Jersey office together to have the opportunity to present to so many of our clients and colleagues and offer this webinar on the state of the market in New Jersey. The discussion today is going to be led by John Obeid, the head of Tri-State Suburban Research. Please feel free to type any questions into the Q&A section. We will try to get to as many of them as possible as we can at the end of the presentation. We slotted this for about an hour. I don't think it'll take that long, so we should have time for a couple of questions. We'll go ahead and jump right in here. John Obeid leads the team that is in charge of all Tri-State Suburban Research for Colliers. In addition to the traditional market reports that I'm sure so many of you see, John provides our clients with assistance around analytics that offer insights to guide strategy and planning. John has put together a robust presentation that's going to provide a picture of the current conditions in the market and then also help us draw some comparisons to previous disruptions. John, go ahead. The floor is yours.
Thank you, Sam. And hi, everyone. I just want to thank everyone for joining us today on this webinar. I hope you're all doing well and are adjusting to our new but temporary normal. So the purpose of this webinar, we're going to go over three items today. First, we'll look at the first quarter 2020 findings for the office market. Then we'll jump to industrial, and then finally look at some economic slides that were released recently. So before we start, just want to know as we go through the slides, just want everyone to keep in mind that our economic backdrop is a little different today than it was during our last recession. So while we're going to look at the past and draw parallels from that, there might be some things that are the same, there might be some things that are different, so we might see some new trends that will emerge. So I usually like to start off any discussion on the market looking at historical net absorption. I think it's a good indicator of the overall health of a market. As you can see, during the latest recession, the office market saw a string of many quarters of negative absorption. But starting in 2014, we saw that luck change. And the 3-year trend line here, the blue line, it's been in the positive range over the last 5 years. So what we saw in 2014 were a couple things. So Grow New Jersey incentives were released that year. So we saw a lot of large tenants take down big blocks of space, particularly on the waterfront market. There's also lease rollover from the latest recession during that time. But since then, between 2014 and 16, absorption stayed positive but sort of leveled off. So we saw that trend line starting to decline. And in the first quarter of 2020, absorption turned negative, just over 300,000 square feet. And this was after 6 quarters of positive absorption. So what we saw during the first quarter, there were a handful of newly available large blocks of space. The largest was a 250,000 square foot block that was added in Basking Ridge, belonged to Everest Reinsurance. They moved to Warren Corporate Center last quarter. So looking at leasing activity in the office market, the first quarter saw 2.3 million square feet leased, and on a quarterly basis, that's pretty much in line with what we've seen historically. Moving forward, we might see a drop in leasing during the second quarter as a result of the pandemic. If you look back during our last recession, between 2007 and 2008, we saw an 18% drop in leasing. When mild demand may fade in the second quarter because tours and lease negotiations may be disrupted once the pandemics and the stay-at-home orders are lifted, we might see an increase in pent-up demand. And then looking even forward a couple of years, we might see we'll have these buckets of tenants who might have renewed short-term during this time, those leases coming due. And then that, in your pent-up demand, we might see down the road in the long term an increase in leasing like we saw after the recession in 2010 and 2011. So here are some of the more notable transactions that occurred in the first quarter of 2020. As it seems to be quarter after quarter, the new norm, leasing volume was led by those mid-sized transactions. In this quarter in particular, we've seen the healthcare industry kind of lead the way. So you had Hackensack Meridian Health. We completed the largest deal during the quarter. We signed just under 163,000 square feet in Metro Park. We had Summit Medical Group signing 2 leases this quarter, one in Clifton for 77,000 square feet and one in Montclair for 40,000 square feet. And that building in Montclair, that's 40,000 square feet, that's a new construction. And in fact, we've seen a couple deals this quarter go into new construction buildings, which is sort of unique. You had Deloitte, which was the largest one. They pre-leased 110,000 square feet at M Station in Morristown. And then not on this list, but also BD Padovano leased 21,500 square feet at a new development site, mixed-use site in Montvale, on where the former Mercedes-Benz site was. So looking at the availability rate as of the first quarter, it's up slightly from 2019 levels at 18.7%, but it's still at recession lows. If you look at the prior recession in 2007, we had a low of 16.6%. Then it increased almost every year till it reached a high of 22.6% in 2013. While we anticipate negative absorption would increase this availability rate, it might not be as high as that 570 basis point improvement increase between 2007 and 2013. And also after the recession, it seems like we were stuck at this 21% range for 5 years before we started seeing some improvement from 2015 and on. So what we saw during this time was, Grow New Jersey, as I mentioned earlier, being instituted. So that took down some large blocks. We also saw some buildings go through major renovations and provide amenities tenants were looking for. So those blocks were getting leased, and we also saw some repurposing of office buildings. So, in the Meadowlands, we saw a couple office buildings in the process of being repurposed to industrial. We've seen some multifamily and just some mixed use redevelopment. So we had some sort of decrease in our inventory, which helped stabilize our availability rate. So over here, we're taking a look at the relationship between that office availability rate and our unemployment rate. So the latest numbers that were released for New Jersey had the unemployment rate for March at 3.8%, which was the same as it was last month. That just further solidifies the point that our market was on solid footing, or the economy was on solid footing prior to this pandemic. Historically, there's been a strong correlation between these two figures. And more importantly, we'll need to keep an eye on which industries are shedding jobs. So once the next month's figures come out, we need to take a deeper dive on the office employment and see how that would affect our availability rate. Because as of right now, most of the jobs being lost are hospitality and retail jobs, which typically don't usually affect office space. So over here, we're looking at the ratio of sublease space to the overall market. So this can show us how well the market is faring. So if you see significant increases in sublease space, that could mean there's some office jobs being shed. So during the last recession, that ratio hit a high of 18% in 2009. And after that, it was slowly pared back to 8.3% in 2016. And during that time, you can see the average asking rent increasing as the sublease decreased. Right now we're at a relative high of over $28 on the asking rent. But however, the last 3 years, that sublease ratio increased to 14.6%. So this can be an indicator that tenants may have been looking at space efficiencies even prior to COVID-19. We'll need to keep an eye on this, as if this increases even further, you might see some downward pressure on pricing. But that typically doesn't happen right away. There's a lag, but we'll keep an eye on the sublease space to see how that would impact the market. And part of that would be to see what spaces come online and what sublease spaces come online and why. So at the third quarter of 2016 and fourth quarter of 2016, we saw a spike in the amount of sublease space that came on. A lot of that were due to really large blocks that came on for a multitude of reasons. But after that, the amount of sublease space that came on quarterly kind of leveled out up until the first 2 weeks of April. So we saw 832,000 square feet of sublease space return to the market. It's important to note that most of that was one tenant, who was Sanofi, who returned 670,000 square feet of space on the sublease market. But still, this is an important figure to track to see what spaces come on and why, and how that'll affect our market. So breaking out pricing by submarket. So our Chatham-Milburn submarket typically has always led the pack in terms of pricing, because in that market you have Short Hills, which has some of the higher priced office buildings on JFK Boulevard. But other than that, the clear winners you can see rounding out the top either offer a live, work, play environment or have access to major transit hubs. So, New Brunswick, Morristown, Newark, Metro Park, and the Hudson waterfront are among the highest. The Palisades submarket, it's really driven by its proximity to New York, and the pricing reflects that. I also want to point out specifically Princeton, which is kind of in the middle of the pack here. So when a lot of people think about Princeton, they think about the Route 1 corridor, which is the largest market area in Princeton, but there's other areas that bring down this number. So along the Route 1 corridor, you have some of your more prestigious areas and buildings, and it's also well located, as you have like Carnegie Center right there. So those buildings really ask the Class A around $30 to mid-30s a square foot. And you have other sections of Princeton and Class B buildings, which brings that pricing down. So there's really a big range between that Class A market in Princeton and then the rest. So if you look at the Route 1 corridor, Class A, that pricing would be more in line with what we see in those other transit-oriented live, work, play markets. Okay, so we're moving on to industrial. And it's no secret that New Jersey's industrial market has been on a hot streak for quite a while. Although it seems like a really long time ago, they did falter during the last recession, gave back a million square feet of space in terms of net absorption. However, that was quickly reversed. Its fortunes changed in 2011 as the economy started getting better and people were once again making purchases. And it stayed that way for quite a while. Net absorption has been positive for the last 29 quarters, which in itself is an amazing feat. And the long-term trend still remains positive. The 3-year trailing average is at 3.5 million square feet. And although if you look at the last 4 quarters, looks like the trend's going down, but in reality, that's really the case of there not being that much space available to absorb and not a lack of demand. So over here looking at leasing activity. For the first quarter, leasing was 9.1 million square feet. It's down a little from the quarterly average, but again, that's because of the lack of available space there is for lease. And looking back to the prior recession between 2007 and 2008, we saw leasing kind of fall off a little bit, 24.3% from those 2 years. So where we are short term, it's still unknown. I mean, while there might be a fall off in the second and third quarter just because of the pandemic and stay-at-home orders, we might see a fall off there, but the long-term outlook still remains positive. I mean, during this time, a lot more people are ordering their goods online, and you know, if that sticks and any of that becomes a permanent part of consumer habits, we could see an increase of demand for these logistics spaces just to store, you know, the excess goods as people turn to changing their habits to buying goods online. And an important part of that is Amazon. Been one of the clear winners during this time. And don't worry, I made sure to shut off my Echo device so I don't accidentally buy something when I keep repeating their name here. But that just goes to show you the major push Amazon has made to get into consumers' homes, and not to just get there, but to get there quickly. So in the last 2 quarters, Amazon's really made a push to ramp up their space needs. They leased a total of 3.5 million square feet in the 4th quarter and 2nd quarter of 2020. Those are some of the highest leasing totals Amazon's done since they first started in 2014. And it's not just how much space they leased, but also where they leased it. Those consumers' attitudes have changed to quicker delivery times. Amazon's been rushing to meet those needs. So you can see in 2014 to really 2017, they were focused on those large distribution centers in central New Jersey to get deliveries and pick, pack, and deliver them to consumers within 2 days. But as their behavior shifted to quicker delivery times and sometimes same-day delivery, Amazon's increased their space search and leased more space in northern New Jersey in 2019 and 2020. I mean, just in the 1st quarter of 2020, Amazon leased almost 1.5 million square feet in northern New Jersey. And I mean, the last 5 quarters alone, they leased more space in northern New Jersey than 2014 and 2018 combined. So looking at industrial rents, they've risen pretty much unabated starting in 2014, all the way up to $8.95 a square foot in 2020. What's interesting here is that lack of available space we mentioned looks to be affecting the trend line over the last 3 quarters, which looks like it's peaked, when in fact, there's been a lot of demand for Class A and properties that are under construction. Those are typically higher priced and are leased quicker. So that space isn't being factored into the asking rents. So it kind of makes it seem like we hit a ceiling when in fact, rents are still increasing and taking rents are increasing as well. So we're able to break out pricing by submarket. Those markets in northern New Jersey that are close to that New York, New Jersey metro population base have a higher priced asking rent. I mean, in fact, you see the Port and the Meadowlands are above $10 a square foot. And Class A and new construction space there could be even in the low to mid-teens. And even all up and down the New Jersey Turnpike, those core submarkets. So you have Exit 8A, Exit 10, Exit 12. We've seen pricing increase there as well. Almost double their Great Recession lows. I'd also like to specifically point out at Exit 7A, all the way here on the bottom, that shows a $4.15 asking rent. Again, lack of available space is affecting this, and we're seeing it on the submarket level. So there's only 1.5% of its inventory is available, And most of that are, really older space that bring down this number, when in fact it should be closer to the rent of exit 8A. So looking at the availability rate in industrial, we're at 4.6%, just up a little bit from last year, which was 4.3%, but again, at historical lows. So any short-term impact this pandemic will have on leasing and availability, not expected to last. I mean, demand was here before, and with consumers shifting their behaviors now during this pandemic to buy more items online, we anticipate demand will still be there in the future. So it's also important to look at some economic figures and how they affect or can affect the industrial availability rate. Like the unemployment rate for office, there's been a strong correlation between consumer sentiment and the industrial availability rate. So the latest numbers that were released on consumer sentiment had it at 71 points as of April, and that was down from 89.1 points in last month. That was actually the largest decline ever recorded. But there is a positive note here. So most of the decline was recorded in what they call the current condition component. So what's happening now, that component fell 31 points. If you look at the futures component, what consumers expect the market to be like, that only fell 9.7 points. So this tells us consumers expect this to be over soon and the economy to restart. So due to the lack of available space in the industrial market, construction has really ramped up starting in 2016. And a lot of this construction is warranted. I mean, nearly half the properties currently under construction are already spoken for before it's even delivered. And with the lack of available land to build on, developers have gotten creative. They've looked at office buildings, particularly in the Meadowlands area, northern New Jersey, to redevelop into industrial or to remediate old sites. So that might take a little longer to get the sites ready. That's why you may have seen sort of lull in 2018 in construction starts. But once those sites have been remediated, we saw some back up to 14.5 million square feet of starts in 2019. So for example, one of the larger sites under construction is Kingsland Meadowlands, which is being built on a former landfill in Lyndhurst. So I'll also look at the sublease share of available space in industrial like we did for office. And during the last recession, we did see that space increase somewhat to just under 10% in 2009. Sort of leveled off after that, reaching a low of 5.5% in 2017. But just the last year, we saw a big spike in the amount of sublease space in the industrial market. And while some of that can be attributed to companies giving back space, most of it is really a testament to how well the market's doing. So what we've been seeing is a lot of users, just because of the lack of available space, lease more than what they need as they anticipate for growth. And they put that excess space on the sublease market just to have it leased since it's not being used. So looking forward, we expect to see this ratio kind of zigzag as the space comes on and then it is leased. But we'll keep an eye on it and see if it increases, and if it does, the reason why. All right, so in the next few slides, we'll be looking at some of the latest economic data and how it relates to our current situation and what its impact will be. And again, just to keep in mind, what we're experiencing now has not been experienced before. So some of these data points will look a bit extreme, but should only be temporary. So New Jersey trade employment that we're looking at here is only updated right now through February 2020. So we're not seeing the full impact from COVID-19, but March and April numbers are expected to be down and to outweigh that of what we saw during the last recession. But again, this is something we should keep an eye on to see if it's a small blip and will increase quickly, or if it's something that would be a little more lasting. So these are the new unemployment claims for New Jersey. And it's another scary chart, but as alarming as it is, we really have nothing else to compare this to. The shutdown of the economy was sudden and new to everybody. But as more time goes on, the more important indicator to look at would be continued claims. It'll show us how many jobs were refilled or how fast people found new jobs. It's still a little too early to look at that for this situation, but that's something we'll keep an eye on as this unfolds. So we mentioned a little earlier, our unemployment change rate has remained unchanged at 3.8%. We'll also look at the employment change too. During the recession, we lost quite a few jobs, and so this is something else we'll be tracking as time goes on. So again, another thing to see, if you look at the 3 month change, will it be a blip or will it be something a little bit more lasting? So again, U.S. retail sales a little alarming, but it was expected. Declined 8.7% month over month. It was actually the largest decline month over month since this data was recorded. Amid the widespread stay-at-home orders, I mean, a lot of analysts expected this alarming drop. And we break it out by industry, and the losses in clothing and accessories and food services and furniture far outweigh any gains in grocery and retail and e-tailing. And clothing stores personally have been hit the hardest during the shutdown, as they were deemed non-essential. And you can see building materials, although up 1.3%, typically during this time in March and the spring, it sees quite a bit of an uptick as people really rush to those big box stores to get their landscaping ready and do any updates to their home once the weather turns nicer. So we've seen a lot of GDP estimates. All the big banks put theirs out, and this one in particular is from the Wall Street Journal. They survey 60 economists, and these are the averages, which are pretty much in line with what other banks are putting out. They anticipate somewhat of a small decline in the first quarter of negative 3.3%, but a larger one in the second quarter, down 26.5%. But most of the forecasts agree that once this pandemic and stay-at-home orders are lifted, we'll see a quick rebound in GDP numbers. So rounding out the end of the year, they see a 6.2 and 6.6% quarterly increase in GDP. And that all has to do with how long these stay-at-home orders last. So our last couple of slides we'll be looking at are some data sets that are put out by companies that they made available that help us analyze the impact of social distancing. So this one here is data put out by OpenTable. So we're looking at the year-over-year change in seated diners. Although not interesting now, as we all know, people aren't sitting down and eating out. This would be important to keep track of. It'll help us see if once the economy reopens, if people are flocking back to restaurants and we'll see a sharp increase, or will they gradually go back as people are still a little nervous to go to these high trafficked areas. Another one here we're looking at is some data that was made available by OpenPath. It's tracking consumer index, indexed at 100%, starting at February 24th. So OpenPath, they track the occupancy rates of buildings they service before and after social distancing mandates. And you can see in New Jersey, it's dropped every week since March 2nd, all the way down to 15.8% the week of April 6th. This will be also interesting to keep an eye on in the coming weeks. It'll show us if employees are coming back to work all at once, or if they'll come in waves. And lastly, this is available data made from Foursquare. It shows indexed foot traffic through April 10th. So you can see, we mentioned in the US retail sales slides, this kind of coincides with what we saw there. You have clothing stores all the way at the bottom here, much less foot traffic there, and at those sit-down dining chains and malls. Offices also down, but where we see either stable or increased foot traffic are grocery stores and drugstores. People still need their food and medicine. So we've seen some stability there. It's interesting, if you look at right after most social distancing mandates were made in mid-March, saw a big increase in people flocking to these stores to bulk up on foods and their prescriptions and toilet paper and paper goods. The future remained uncertain, but that kind of leveled off, and people are still going, but not as much as they were before. All right, so just want to thank everyone for staying with us and listening here on this webinar. I know we're all in uncharted waters, but we're in this together. So I just want to end it with our market has faced problems before and downturns in the past, and there'll be some changes, but usually we always typically get out of them and for the better.
Okay, thanks, John. So a couple of things, right? I mean, clearly, just a few observations for those listening. First of all, a lot of the data that we're looking at was from the first quarter, where most of the bulk of that was pre these stay-at-home orders. So there's some of this which is going to be, some of what we're looking at here is creating a benchmark so that we can start marking what it's going to look like as we move through the stay-at-home orders that we're experiencing right now, and then as those are lifted in the coming months, right? So some of this, the purpose of some of this is to create a benchmark so we can start measuring as we move through it, and create some predictive analytics. So it's important for us to establish where we are at the beginning. We did have a couple of questions that I'll do my best to answer or take a guess at. So the first question was, so what is the impact that we're anticipating on office rental rates as activity and demand has slowed? And our answer to that right now is that nothing in the short to medium term is changing, right? And the rental rates tend to move, as John had discussed earlier. Rental rates in office space tend to move in lockstep with demand, and then also in reaction to competitive sublease activity. So neither one of those have we seen in any kind of substantial way, I would say, yet, right? So we don't know what's going to happen. The bulk of the space that's been put on the market so far has been one large sublease, so we haven't seen that happen yet, and we're going to have to just wait and see how the new normal and how companies are choosing to use their office space is going to impact demand for space, which will then have an impact on rental rates. So we probably anticipate getting a handle on that and starting to see movement, I would say 6 months from when we started this, which I think is really what we're seeing, because at least speaking from the experience that we've seen in our office, the deals that were close to the finish line are tending to get done. Deals where tenants had 6 to 9 months before their lease expires, I think everyone is just pressing pause and waiting to see what's going to happen next. And then we had another question about when are we going to see rental rates return? I mean, that's sort of the same kind of question, same kind of answer that I just addressed. And really, we're in a bit of a wait and see right now. I think a lot of this is going to have to do with how comfortable tenants are and employees are walking in and out of these buildings, and how much the employers and landlords are doing to create a sense of safety and security inside these buildings. Noah, did you? I can take you off mute here. Did you want to add any color around some of the industrial trends that you're seeing?
Sure. Yeah, I mean, what's sort of keeping us busy on the industrial side is really just trying to capture as much data and data points as we can, because the main issues, if you will, right now are, what is market rent? What are cap rates today? What does rent growth look like? All questions that are surrounding underwriting. And those are tougher questions to answer when there's limited deals to point to and limited velocity. That's not to say that there's not strong demand still. There is, but the deal velocity is just slowed down to a crawl, because in order to get a deal done, you need lots of people that are involved, lots of moving pieces that needs to be satisfied before things can be done. Municipal approvals in some cases for even building fit outs, and those municipalities are at a standstill. So we're highly focused on trying to capture as much data as we can, versus speculating on what we believe could be the new normal, or where we could be when we come out of this. I think a lot of the fundamentals for industrial, both in New Jersey and across the globe, but certainly across the U.S., consistent feedback and data that we are gathering is that the demand is there. There are some interesting kind of nuance associated with that. Some of it is short-term requirements, need to have just Band-Aid kind of answers to things. But generally, that the industrial market remains strong, and will, if I may speculate a little bit, all indications are that we're going to be coming out of this and guns a-blazing. Things are going to be getting back to quote unquote normal from an industrial real estate perspective very, very quickly. And then it'll be time essentially that we'll have to just kind of wait and to realize what the impact of all this was from a medium and long-term perspective, from corporate supply chain, onshoring, nearshoring, those types of things. Those are going to be long-term projects, if you will, to have answers to what that's going to be looking like.
Okay, thanks, Noah. We just had one other question, which is a request for a copy of the presentation, which yes, we will find a way to get the presentation to the people who are on the call today. So happy to do that. Does anybody else have any other questions I want to go ahead and type in before we wrap this up? Okay, it doesn't look like we have any other questions at the moment. Feel free to reach out to any of the Colliers brokers that you do work with to answer any other questions, have a more in-depth discussion with any of these submarkets that you're concerned about. We do appreciate you joining us on this call today, and we look forward to continuing to update this data for you guys to use going forward. Thanks, and have a great week.